Hey traders and investors, it's Serge Berger here. Today let's have a look at Netflix. Netflix is scheduled to kick off a big tech earnings week this week, right after the close of trading today, Monday, April 21st. And the stock has, not surprisingly, with most of the new sort of techie kind of things, dropped quite sharply over the past, let's call it a month and a half or so. So if we just kind of scale back the chart a little bit and see what the stock has done, it's basically done a fairly classic sort of 1, 2, 3 wave move, sort of wave 1 here up into 2011 top, then wave 2 into the 2012 lows, and then of course the third big wave here that just took place where the stock topped out in let's call it late February, early March. So from that point of view, the stock's actually done a fairly important sort of three-wave, longer-term move, and could, from that point of view, be ready for a real some more meaningful consolidation on the downside. If we zoom a little bit closer, you can see that so far the stock has more or less been able to hold itself near the 200-day moving average, which is this red line. Okay, but if we draw a very simple Fibonacci retracement level, you can see the stock so far has really only retraced about 38.2 ish percent, which is an important sort of second important support level for Fibonacci. But a more meaningful retracement, or even a more meaningful consolidation phase, would really take the stock somewhere near the 50% retracement mark, potentially as low as the 61.8% retracement mark, which would be somewhere around $260 to $210 on the downside. In terms of earnings, Netflix can be an extremely big mover around earnings. Just look at, for example, back last October when the stock rallied big intraday. This red bar here, but then within literally half an hour of trading, reversed even bigger, and at ended the day down quite significantly. Then, of course, in January we had a big rally up that continued into the late February, early March top. So at this point, the stock's at a 200-day moving average, which, by the way, it hasn't touched since let's say late 2012. So from here, if the stock really wants to continue going up, it really has to do something. And I do think if the stock can sort of rally a few percent at least, then it should have room into 380 to 400 bucks. At which point it's going to be retesting its 150-day moving average. That's these two lines here, for the first time from below for a long time. Okay, so keep that in mind. So basically, unless the stock really rips higher and goes to 440, it still has to prove a lot and try to get past above, say, a $390 to $400 mark. So on the long side, the stock's actually, I think, much trickier to trade at this point, at least from what I know going into earnings. On the downside, I think it's very defined. If the stock basically breaks below 312, which was the lows just last week, then it would certainly give us a very clear, defined statement that it says, okay, listen, this 200-day moving average, I can't hold it anymore. I'm going lower, right? In that case, those levels I mentioned before, anywhere between, I guess, what was it, 210 to 260 could really be the next support level. So I think the long side here, like I said just a minute ago, is a little bit trickier. We need to see a little bit more confirmation on the long side to really be able to trade, to stay in the stock for longer than a couple days. On the short side, if you get a size of close below 312, I think the stock goes lower to 260 at the very least. Hope this makes sense at all. If you got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader. Take care.